Way into the utilization of the commercial loan.
Yeah, operating cycle. The way I think of it, simple terms, essentially, the moment you take cash out of your pocket as an owner or out of the business and you put it elsewhere to start a process, the total operating cycles go from the start when you take money out to all the way until you receive money back in. In theory, clothing retailer, they may buy inventory for $10,000. That inventory may take a week for them to get there. So $10,000 goes out of their pocket day one. They don't get the clothes until a week later. Any retailers that's watching, if it's 3 days, I'm just bear with me. So that inventory may sit for 2 weeks before it sells. So it takes about 2 weeks to sell. Again, let's say if they sell 15,000. Most business transactions, and maybe it's not retail, again, bear with me. Most retailers, there is credit terms, meaning if I buy from you, I have 30 days to pay you. Retail may be more of an on-spot transaction where it's more cash. Let's say half of it was credit transaction. 15,000 in sales, 7,500 was credit, and 7,500 was cash. Let's say that's a month of sales. Cash collections on day 30 is 7,500. Then you got another 7,500 that's due in another 30 days. So your cash collection or your operating cycle is 1 to 30 to 1 to 60 days. There's cash that you've put out of your pocket that you're not going to get until 60 days. Now, this is on the short end. There's manufacturers that build stuff, that buy raw materials like resin and plastic. That process can go on for, 66 months to a year, depending on how specialized that product is. The importance of that is cash flow. In that process, there are bills that are due. There are payroll that's due. And how are you managing that? A lot of people manage it internally themselves from just saving cash, and that's great. Sometimes this is where banks come into play, and it goes back to the purpose of lending to support an operating cycle. And what's unique and fascinating about what I do is that operating cycle varies from business to business. So I get to get in there and say, tell me about your cash flow. Tell me about your accounts payable, accounts receivable. Let me understand how things are happening here. What are you making? What are you selling? How are you selling it? What are the terms? Is there any shortfalls that I can help? And it's fun. I think I covered most of everything. For, I guess, the first 2 points there. You have anything to add there, Jay? Or
I just wanted to break it down on the personal side, 30-day cycle. Within that month, I got bills to pay. I don't know what's going to happen within that month. I just know, and I've got to function within that 30 days. It's just the same as you managing your personal finances, the same you have to work the business. You got to know when your money's coming in and how you're going to have capital to use to keep your business flowing, the same as you do your household.
Yeah, no, that's well said. And I think knowing it and then also being able to articulate it to me as the banker, you can have your own scratch sheet system going on. But again, we're talking about what the process looks like for a commercial loan. And that's one of the questions that I'm going to ask is, what does your cash flow look like? Do you have a 13-week cash flow statement? Now, not all situations require that, and I don't want to scare anyone, but having some thought of where because again, another credit officer told me this. He said, businesses don't go out of business because they lack sales or business when they are unable to pay their bills. It's cash flow. It's not net profit. I don't want to get too detailed, but basically net profit is one thing, but understanding how cash flow works is very important.
You want to talk about the capital stacks? And
yes,
the last two there?
Yes, broken in half because the first two is more so like short-term lending needs. So understanding the operating cycle, how we can support that. Most of the time, operating cycle is within a year, 12 months. The second point here is strategic growth, and that's largely dependent upon your capital stack. And what that means is basically how you have funded your balance sheet or your company. So that could be equity from owners, senior debt, mezzanine debt. But I think what is important is to understand operating cycle, purpose of the loan, how financing entity can help with that. And then from a long-term perspective, what's the purpose of the request? Strategic growth. Where is your company going? And then how are you going to fund that destination? Equipment financing. Maybe you need a particular equipment to do that. Are you going to fund that out of pocket, or are you going to fund that with a finance? Let me give you another example. Commercial real estate. So buying and getting into a bit larger space. How are you financing it? And so those loans typically are more than a year. just kind of understanding the difference between short-term lending, long-term lending, and both are purpose driven, and understanding that it will help you have the conversation with any lender.
You got the operating cycle down, you're supporting your operations, everything's going pretty good. And maybe look at growing and scaling your business. Like you were saying, you want to leverage your capital for your growth. If you borrow money, at least maybe have money to pay it back. Some companies, they prefer to leverage before they use their own money, if you can get to that point.
That's well said. Thank you for adding that. That's very helpful, how they're more so connected than what I articulated. That's really good. Thank you.